Why is NVIDIA dropping today? NVIDIA technical analysis and price prediction. NVIDIA support resistance levels 2026. NVIDIA insider selling impact. Best NVIDIA trade setup after hours. NVIDIA earnings whisper number. AI stock sell-off June 2026. NVIDIA liquidity grab playbook. You're looking at a stock that just lost $8.65 in a single session, with the director's trust dumping $186 million in shares while Asian markets are screaming that the AI trade is over. I'm not here to give you a news report. I'm here to tell you exactly where the trap is set, where the money is hiding, and where you will be if you don't have a plan by the end of this video. Right now, NVIDIA is sitting on $200 flat. That number, 200, is not just psychological. It is the battlefield between institutional distribution and the retail hope trade. And there is one danger zone, and one hidden opportunity, and I will show you both in the next 60 seconds. Stay to the end, because I am giving you 3 exact trade plans, with entries, stops, targets, and the on-screen graphics you can screenshot right now, that you can trade today. Let's get the instant market verdict. The session bias is bearish to range-bound with a violent mean reversion pulse building underneath. The daily chart is a strong sell, the 4-hour is a strong sell, the 1-hour is a strong sell, but every oscillator is screaming that the rubber band is stretched to its absolute limit. My job is to fade the crowd, not join them. The herd is piling into puts, buying downside protection, and shorting every tick lower. That means a liquidity squeeze is brewing. The single invalidation level that flips my entire bias is $212.52. Write this number down. If we get a 4-hour candle close above $212.52 today, the entire bearish structure resets. That's the pivot, that's the line in the sand, and above it, I am no longer looking for shorts. Below it, I treat every bounce as a gift from the market. But here's what most traders miss. The dangerous zone is not below 200. It's exactly at 200. Because when a level is this obvious, institutions will engineer a stop run, a liquidity grab below the figure, to take out all the weak longs, collect the stops, and then reverse. That's where the opportunity lives, and I'm going to map it for you. Now let's go deep into the technicals, top down, so you can see the architecture of this move. On the weekly chart, the trend is still officially a buy, but it's tired. The 200-week moving average is far below us, and the 20-week moving average is rolling over. The weekly MACD is starting to curl lower, and that's a warning flag that the multi-year uptrend is taking a breath. On the daily chart, it's an entirely different picture, a strong sell signal, with the price collapsing through the 20-day moving average at 209.22 and the 50-day moving average at 206.82 as if they weren't even there. That's institutional selling. You don't slice through 2 major daily moving averages in one session without serious distribution. The daily MACD is negative, printing minus 1.46 and accelerating lower. The RSI is at 42, and the Williams percent R is minus 97, deeply oversold but not yet turning. That means we can get even more oversold before the snap. The only thing holding this market together right now is the 100-day moving average at $200.23, and just below it, the psychological $200 big figure, which coincides with our S3 support at $199.98. That zone, from 200.23 down to $199.98, is the floor. If it breaks with volume, the next leg targets the 200-day moving average at $187.90, and that's an institutional target. Now, drop down to the 4-hour chart, and this is where the trap becomes crystal clear. The 20-period moving average on the 4-hour is now at around 205.50, and the 60-period is at 208, both sloping down aggressively. We are seeing a textbook death cross on the 4-hour time frame, and every pop toward the 20-period moving average is being sold. The MACD on the 4-hour shows a hidden negative divergence. Price is making lower lows, but the MACD histogram is making higher lows. Wait, let me say that again. Hidden divergence. Most traders see oversold readings and jump in long. Hidden divergence, however, tells you the trend remains intact and momentum is still bearish. This is the part most traders miss. The bounce will come, but it will likely trap early buyers, fail at resistance, and then resume the down move. The 1-hour chart shows an even more aggressive picture. The Williams %R has been pinned below -90 for multiple candles, and the CCI is -144. That's an extreme compression. What typically happens after such compression is a sharp, violent unwinding. A 30-minute candle that rips 20 points higher, stops out shorts, and then fades back. That is the liquidity grab scenario I am positioning for. Here's the cross-asset linkage that confirms the macro pressure. Asian semiconductor stocks got hammered overnight on a broad tech sell-off, with AI valuations facing a new scrutiny. At the same time, the dollar index is firming, the 10-year yield is steady, but the VIX is ticking higher. That combination, stronger dollar, rising volatility, and a sector rotation out of high beta names, is toxic for NVIDIA in the short run. When I see a director's trust sell $186 million of stock, I don't ask why. I understand that insiders sell for many reasons, but the optics hit right when the daily chart is breaking down. That's a sentiment accelerant. It gives the macro narrative a face. So my 1 to 2 week directional lean is bearish, targeting a move down to the 200-day moving average around 188. The event that invalidates this lean? A weekly close above 216.39, the R2 resistance. Below that, every rally is suspect. Do you think NVIDIA holds $200 this week? Comment hold or break right now. I'm tracking consensus, and I want to see if you're aligned with the institutional flow. Now we get to the section most people skip, the actual trade setups. If you're still watching, you're already in the top 5%. Keep watching, because this is exactly where the money is made. I'm giving you 3 strategies: sniper, active trader, and aggressor. With on-screen trade cards you can screenshot. Strategy 1, the sniper, the conservative play. This is for the trader who waits for confirmation and only takes the highest probability break. The trigger is a 15-minute candle close below 199.98, the S3 support and the line that holds the entire structure. If that level breaks with a body close, not just a wick, it signals that the liquidity grab failed to attract buyers and the institutional stops are now running. Entry on the break, ideally with a retest of 199.50 to confirm resistance. Stop loss goes above the broken intraday support turned resistance at 2385. That's the next level up, and a move back above it signals the break was a fake out. Target 1 is 195.50, and target 2 is 192, giving you a risk-reward ratio of roughly 1 to 2.6. Invalidation. If price manages to reclaim and close above 206.25 on the 4-hour, the entire downbreak is void and you cut it. That setup is clean, mechanical, and lets the market do the work. The sniper, entry, 199.98, 15-minute close below, stop loss, 203.85 take profit 1, 195.50 take profit 2, 192.00 risk, reward, 1:2.6 invalidation, 4H close above 206.25 strategy 2, the active trader, the standard swing fade. This is where you sell the bounce that everyone else is buying. Look for price to squeeze up into the 206.25 to 207.50 zone. That's the confluence of the broken 50-day moving average and the intraday resistance cluster that was formerly support. Wait for a 1-hour candle to stall and show a bearish rejection wick, a shooting star or a bearish engulfing pattern on the lower time frame. Enter on the next candle's break of that rejection low. Stop loss goes above the pivot at 210.12, which is the central magnet that if breached turns the tide. Target 1 is 200.50, right where the 100-day moving average and the big figure will act as a magnet. Target 2 is 197.80, a measured move extension. Once target 1 is hit, move your stop to break even and trail the remainder by 2 times the 15-minute ATR. This setup capitalizes on the mean reversion that will inevitably come, but it trades with the daily trend, not against it. Type your NVIDIA range for tomorrow, high and low, in the comments now. Let's see who's reading the order flow correctly. The active trader, standard FAD entry, 206.25 to 207.50, 1H bearish rejection, stop loss, 210.12 take profit 1, 200.50 take profit 2, 197.80 trailing stop, BE after TP1, trail by 2x15M ATR invalidation, 1H close above 210.12 strategy 3, the aggressor, the high-risk scalp. This is only for those who can lose small and manage risk aggressively. I'm targeting the long liquidity grab at exactly $200. When price spikes below 200 on a 5-minute candle, sucking in breakout shorts, you wait for a rapid reversal candle, a bullish engulfing or a hammer with a long lower wick, back above 210 cents. Enter long on that reclaim, with a tight stop loss at 199.50. Target 1 is to 385, the first overhead resistance, and target 2 is 206.25. This is a counter-trend scalper's delight, but it can blow through your stop in seconds if the real selling resumes. Risk-reward can be 3 to 1 if executed perfectly, but the win rate is much lower. Only take this if you have the screen time and the nerve. Again, explicit warning, this is high risk. Do not over-leverage the aggressor, high-risk SCLP entry, 200.00, 5 minutes bullish reclaim after spike below, stop loss, 199.50 take profit 1, 203.85 take profit 2, 206.25 risk, reward, 1:3.0 R invalidation, 5-minute close back below 199.98 risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like funk minutes or sudden tech headlines. Stops are non-negotiable. This is how you survive to trade the next big move. The markets will always be here, but your capital won't be unless you protect it. Close and retention loop. The single most critical level for the next session is 199.98. Hold above that, and we get a ferocious bounce that punishes late shorts. Lose it on a daily close, and the path to 188 opens like a trapdoor. Tomorrow's wildcard is the VIX futures roll and any after-hours headlines out of the AI supply chain. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. I'm out.